So while data wise shows that the market is still going up or picking up, the actual market sensing probably not so much. And on to our last prediction. I kind of predicted that the market will pick up in the second half of 2023, basically based on two reasons. First, the continued undersupply, and secondly, because I did expect the demand to pick up with a push in HDB upgraders. While technically, the data suggests that the market did pick up, right, off the back of 2022, there was still a continued rise in private property prices based on the property price index. But if we were to be critical with ourselves, right, you don't sense the kind of euphoria, the kind of FOMO that we sensed in 2020, 2021, right? The kind of sellers, intense sellers market, bidding wars, units being put up, sold in a jiffy kind of thing, right? Or similar to what we saw in 2018, early part of 2018, leading up to the cooling measures in 2018. So while data wise shows that the market is still going up or picking up, the actual market sensing probably not so much. And so let's dive down into the reasons why we don't yet feel the euphoria in the market. And so I want to touch on perhaps some of the reasons why I thought the market would have picked up in the second half of 2023, right? On a euphoria sentiment basis other than the data perspective. So I bring us back because I really feel where we are in the market today in terms of supply is very similar to, perhaps this is a better chart, very similar to the 2017 period. Again, right, bringing back this table again, right, the total number of unsold developer inventory. Okay, so notice how we are very close, very similar to the 2017 period. And when that happened, right, it led to a surge in demand for land by the developers, and they bought it up, and that brought huge spike in terms of their unsold inventory. But that also correspondingly, so this is the same table if you look at it in terms of the unsold inventory, right, that kind of led to a sort of delayed spike. You see this turn over here where they started to buy up more land, and because they buy up more land, the new supply is at the new benchmark prices, and when they launch, then it lead to that spike over here. But of course, this was on the tail end of a consistent drop in the prices, so maybe that was why we saw this huge uptick. The difference here is that today the property price index is already on the upward trend. That's the difference over there, which is why data suggests that it still continue to go up, but sentiments wise not so much, right? But without going into too technical on the data kind of things, right, notice how the developers were not as bullish as they used to be, right? They didn't come in, right? So all this I explained a little bit earlier on in terms of the construction costs and whatnot. So in the absence of which there is not that much supply in the market, even for the new launch perspective. And when they were still bought up pretty well. So on that note, on that small sector in the market, there is still some euphoria, so to speak, but not so much in the resale market. And this is just one of the reasons why we don't feel the euphoria as we did used to see at that point in time. Sharing another data point, right? This is a tracker of MOP numbers to the private property price index. So notice again, right, in 2019, right, there was a huge spike in HDB MOPs, and that sort of led to this sharp increase over here in the private property price index. Okay, now we see another bumper year of MOPs in 2022. If you follow this trend on pump, high number MOP, spike in prices, 2022 bumper crop of MOPs, sort of, if you draw the similar correlation. So this was why I felt, or I took this indicator as like, we're going to see a bumper crop of people coming into the private market on the back of low supply would have led to a sharp spike in the market, you know. The conclusion is, why didn't that happen, right? As we have seen in the data previously, you know. This may be one of the reasons, right? Because previously when I made that assumption or made that prediction, I didn't really see the breakdown in terms of the trending of resale applications as a function, right? Correlated to MOP numbers. So you see over here, this was the table that I shared earlier, right? MOP number is high in 2019, but actually you see the pickup in the applications was somewhat delayed. The spike over here, but you see the application number didn't spike so much immediately in 2019, but came slightly later on in 2021. Of course, if you strip COVID aside, but you do notice the trending is upwards, right? So conclusion is there's sort of a delayed reaction to the bumper crop of MOP numbers. These are the kind of some of the summary of what has caused the delay in the pickup of the market. I would say the main thing over here is that interest rates have remained high. As we said, I repeat again, interest rates are the grease in the gears of the real estate market. Basically the grease in the gears of the entire financial market, and of course, of which the real estate market is a small subset. And so then that has led to, you know, number one, with developers not buying up the land at overly aggressive rates, right? Delay in benchmark prices being set. I mean, some of the benchmark prices have been set in the new launch market, but the resale market, because volumes are low, as I indicated over here, has not yet seen the speed to reach the new benchmark prices that has led to this sharp increase over here in terms of the property price index, okay? Reasons for the low volume I have shared with us earlier on in the video, so I won't really repeat that. Again, right, there's the HDB price resilience, right, bringing us back to, again, this table over here, right, with prices tracking very similar to one another. HDB owners really aren't that incentivized, or, you know, aren't in a rush, as much of a rush as they were in 2018, 2019 to make that move, as opposed to during that period of time where HDB prices and private prices were moving in opposite directions, okay? If and when that repeats itself, right, so moving forward, if private continue to go and HDB sort of tapers off or come down, that is where I predict would be sort of the trigger point. So first trigger point, interest rates, right? Second trigger point, HDB prices. So of which HDB prices have proved to be surprisingly resilient, of the reasons I've explained earlier, right? That has pushed back, delayed the upgrader demand push, right? Again, you could also exchange the word delayed with pent-up. So again, I still stand by what I said in 2022 that surge can be quite strong because of a lot of this pent-up demand, so to speak, okay? And I want to bring our attention to this, the unseen effects of interest rates, okay? What most of the market deems to be the reaction of interest rates to property prices is interest rate go up, people can't service their mortgage, you know, then they're forced to sell the property, or they are in a rush to sell the property. But that is really the theory, a very outdated theory already. As we have seen, Singapore, the average LTV is below 50%, 40 something percent, so nobody really is going to rush to sell their properties because the interest rates have picked up. But why, again, the interest rates have impacted the volumes in the market? It's the fact that the stress test that the banks use to evaluate how much loan you can take has been bumped up from previously in 2020, 2021 at 3% as MAS has stipulated, 3.5%, today to 4.7%, right? MAS stipulates 4%, but the banks, kiasu, they have utilized 4.7%. Just to put things into perspective on how many percent or how much of a difference that makes to someone's budget. If you have a combined household income of 10,000, the difference in budget, it's 130,000. If your combined household income is 17,000, it's 200,000. 22,000 is 217,000. But if you break it down, it's in the ballpark of 9% difference in your budget. So now if you look at this, and what's going to happen, right, once interest rates normalize, or, you know, if they do come down, I don't expect the banks to keep their stress test or unnecessarily penalize themselves in terms of the stress test interest rates to keep it at 4.7%. All it takes is for one bank to adjust their stress test rates down, the rest of them will follow, and they will then all adjust back down to the MAS stipulated 4%. So with that, people all get a bump in their budget. And so as I explained, a lot of the reasons for the low volume is because sellers asking prices are high because their replacement cost is high, right? And buyers can't seem to reach that asking price also because of the loan, the TDSR loan that they can take. Probably their equities. There are a lot of the clients I work with, they do have the equity probably stuck in their house lah, but they also have equity. In terms of equity, sufficient, right? But the loan is the one actually that's holding them back. A bit of a difference between what's happening in the market today as opposed to the previous years, right? It's the loan issue. So now, if they get that bump up in the amount of loan, that brings that gap a bit lower. And definitely, some of them, the needs-based ones, will come in and breach that gap. And whenever one seller sells a property, he becomes a buyer, and then that then leads to that chain reaction. Then that creates that upward push in the market in terms of volume, like we used to see.